There are two things you rarely find together: growth and yield. They're like oil and water. When a company has one, it tends not to bother with the other. Growth businesses have better things to spend their money on than dividends, while dividend aristocrats prefer to return cash to you, the shareholder, rather than shelling out fortunes to gamble on growth. But every now and then, the market will give you a gift: the high-yielding stock of a company with a decent growth rate. Right now, you're getting two of them. You're getting AT&T and Dow Chemical. Yep, AT&T currently sports a 5.5% yield, and Dow pays you nearly 5.6%. Admittedly, their yields were even more enticing 2 weeks ago, before the stock started climbing, although they're still in the sweet spot between 5 and 6%, and that's where you know the yield is generous, but it's not so high that it's a red flag. Above 6%, you got to start worrying whether they can maintain the payout. Usually, they're worried about the fundamentals and believe that the dividend may not be cut. I don't know. They're good at 6. I'm not. That's why I always warn you not to reach for yield. Never try to get a few extra pennies in dividend if the underlying business isn't doing well. Now, until 4 days ago, I was worried that both AT&T and Dow might fall into the bucket of dividend stocks that I found too risky. But then last week, I interviewed Jim Fitterling. He's the CEO of Dow, and he made it clear that costs are coming way down, while pricing for key chemicals is either bottoming or turning higher. Plus, the free cash flow is very bountiful here, much better than I imagined. And Dow's earnings for interest, taxes, depreciation, and amortization more than cover its quarterly distribution of 70 cents per share. Now, how about AT&T? Last year, I had the privilege of interviewing Paul Singer. He's the legendary head of Elliott Management. That's an activist hedge fund with an incredible track record. Not that long ago, Elliott snapped up $3.2 billion with AT&T stock, and they presented a comprehensive plan to unlock value. Under CEO Randall Stephenson, get this, this thing has lagged the S&P 500 by about 100%. The stock was at $39 when he took over in 2007. Today's at $38. During that same period, Verizon's gone from $38 to $60. Fortunately, rather than trying to fight Elliott, Stephenson seems to have gone all in with their suggestions. By following Elliott's plan, the company could earn $4.50 to $4.80 per share, which could make the stock a $60 stock without that much difficulty. I'm mulling this one over for my Charitable Trust, which you can follow along by joining the ActionAlertsPlus.com club. So what's the plan here? Stevenson's conducting a full portfolio review, including the possible disposition of DirecTV, which is still losing customers, although not as rapidly as it used to. Plus, the chairmanship and the CEO job will be split for greater accountability. In short, everything's on the table. Now, this is a scenario where I bet AT&T can keep delivering modest dividend growth while paying down a huge amount of debt that it took on to buy DirecTV and Time Warner. That said, I know Dow and AT&T. I know they're both challenged. I'm not going to kid myself. I myself have argued that Dow stock could be toxic because the company makes all sorts of despised plastics that don't break down that easily and therefore be shunned by millennial money managers. But you know, one look at a slide in the deck from the latest quarter shows you that plastic may be more environmentally friendly than we'd like to think, because it takes an enormous amount of energy and chemicals and trees to make any kind of alternative. Plus, Dow's making a major effort to make more plastic from recycled fibers. As for AT&T, I know it lost 1.4 million pay TV customers this quarter. The numbers weren't great, although Stevenson said the subscriber numbers are bottoming. What matters to me is that the company will cease making acquisitions and start to pay down the debt with asset sales. Plus, tomorrow, AT&T reveals HBO Max, the new streaming system to compete with Disney Plus and Apple TV plus NBC's Peacock. It won't be out officially until spring, but it's the first sign that Time Warner acquisition could produce some solid growth, not just cash flow. Either way, at a moment where bonds are paying you next to nothing, the 10-year currently at 1.85%. Dow and AT&T stock offer you a twofer, higher yields with a real chance for growth. I recommend buying some here and then maybe wait for the Fed to say something boneheaded on Wednesday and slams the market, or maybe the Labor Department non-farm payroll on Friday shows a surprise drop. You can buy some more then on weakness. Be patient. Dow and AT&T are now, in a safe way, paying you to wait. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.